Welcome everyone. We're going to give just a minute or two for a chance for everyone to trickle in before we begin. So welcome, and we're glad to have you here. Okay, hello everyone, and welcome to PPP Loans 1 and 2 and the stimulus package, What You Need to Know, our latest in a series of all things PPP guidance. We're glad to have you with us this afternoon, so welcome. Dave and Mark have lots of information to cover, so before we get started, I'd like to go over a few quick housekeeping items with all of you. This webinar will be recorded, and we will be sending you out a link along with a copy of the slides. So be sure to be on the lookout for it in your inbox early tomorrow morning. This webinar will run about an hour and 30 minutes with a Q&A session immediately following. If you have any questions for Dave and Mark, please put your questions in the Q&A box located in your Zoom toolbar. To find that, just hover over your mouse, use it for the top or the bottom of your screen, and the Zoom toolbar will pop up. So without further ado, I'm going to hand it over to you, Dave. Take it away.
Thanks, Jill. Hello, everybody. I'm Dave Myers. I'm a tax partner here at LSL, and I'll let Mark introduce himself. Go ahead, Mark.
Hi, everybody. I'm Mark Zimmerman, and I'm LSL's Tax Director.
So here we are again. It's like deja vu, right? Just kind of put on your, look in your think back in your memory and where we were about 9 months ago when PPP-1 was coming out, and the whole feel of PPP-1 with we call it the Oklahoma land rush. And this time around, it has a different feel. And I think maybe it's what we call the new normal. We're all kind of getting used to this, all the things around us. But there is a lot of uncertainty and even some anxiety even about PPP-2 and how this is going to work. And I just wanted to share with you some stats that I heard today on just comparing PPP-1 with PPP-2. And PPP, again, is the Paycheck Protection Program, for those that don't know. So last year, after about a week of the portal being open, there $200 billion PPP-1 last spring, there was $200 billion of loans approved. This time around, during about the same time period, there's been $10 billion worth of loans approved. So you can see it's just not the same activity and not the same feeling that we had last time. And the average loan so far is about 80,000. So the other thing that's a lot different is this is a little more targeted. This is a little more, for smaller businesses. And so, it has a whole different feel. 15% of the loans approved so far are PPP-1 loans. And yes, we'll get into that. Under this program, you can apply for PPP-1. So the feeling is this time it's not pedal to the metal like we had last time. And we really need to be a lot more thoughtful because we know kind of how everything works. And we have to coordinate our application, the forgiveness for PPP-1 with a new beast, the employee retention credit. And we're going to get all into the details of that later. So that's kind of the feel. And an analogy is that I heard is PPP-1, we were building the airplane from scratch as we were flying it. PPP-2, we're building the airplane as we're flying it, but we're we've already got lots of the parts together, so it's not quite about a mess. But just think, we passed the law on December 27th. This new law was signed, and on January 19th, all the loan portals are open for this round. So it's been quite an accomplishment, and it's a tribute to the lending institutions, the SBA, the Treasury, and a big tribute to Congress. So with that, let's move on. So we've already done it. So this is what we're going to cover today. PPP 1. We're going to go first. And really, what do you need to know about applying for forgiveness and what steps you should be taking right now? And then PPP 2, we'll go into that. And the big question is, do you qualify for PPP 2? And how much will you get and what steps you should be taking right now? The third thing is the employee retention credit. And this is a significant change in the law, and we will cover that. Mark's going to go through a lot of that, how this can generate a significant relief for your business. And then we'll do a real quick high-level summary of just some of the major tax provisions that were in the year-end bill. And then finally, we're going to leave room for Q&A. So like Jill said, if you have questions, then put that into the question area, and we will attempt to answer as many questions as we can. So here we go. PPP 1 loan forgiveness. And the biggest thing, it was the biggest Christmas present. If you read our blog, we focused on all the presents that we received from the law that was passed, and the biggest plum was the Congress came in and said, when we said it the first time in the CARES Act, we meant it. Forgiveness is non-taxable, and deductions that you use to generate the forgiveness are deductible. No tax attribute is reduced, and no basis increase is denied. And what those last two would be another possible way that Treasury could come in the back door and make it essentially taxable by denying basis increases and reducing tax attributes. Tax attributes are loss carryovers, different things that they could possibly effectively make it taxable. Congress said, no way, no how, you're not gonna make this somehow taxable through any method. And by the way, in the law, as it was going through the snake, the pipeline, Treasury and Mnuchin was up lobbying against this provision, and along with Bernie Sanders. So we were very much relieved that Treasury didn't have their way, and as we said in our Christmas letter, Scrooge and Marley didn't get a say at the table. So this result, and the good news also is that it's both PPP 1 and PPP 2. So federal law, we're golden on that. California, this is a whole different story. And California enacted its own law, AB 1577, and basically said we're mirroring federal law, but they really were kind of decoupling. And I think they wanted to enact a statute that in case Congress did what they did, they could decouple and basically say that they're effectively taxing the forgiveness of PPP. It's a tricky way it's worded, but they say forgiveness, the forgiveness is non-taxable, but the deductions paid or incurred related to the forgiveness are not deductible. So here's some problems with the law that we see. And this is kind of like getting down into the weeds a little bit, but I think it's worth kind of getting into the weeds and discussing this because we think there's opportunities and there's at least a wait and see attitude that we have to have on this. So the statute reads that it's only applicable to taxable years beginning on and after January 1st, 2020. So this creates the following problems. What do you do with fiscal year taxpayers? So a corporation that has a June 30th year end and let's say, or a September 30th year end, let's push it down further. And they have applied for, got a loan, and they apply for forgiveness, but they don't get forgiveness until December. And so what happens to them? If the law only applies to taxable years beginning after 1/1/20, then is the loan tax free or what happens? So that's the first problem. And the second is, what do you do when, as in the case of most taxpayers or businesses, when you get forgiveness in 2021, but the expenses are incurred and paid in 2020? So forgiveness, is it that the forgiveness, when you get it in 2021, is non-taxable, and then the expenses in 2021 would be that were paid or incurred to get the forgiveness would be zero? So would you be able to not have any taxability? That's the two problems. And so the Franchise Tax Board has come up with a solution. They think they adopted the revenue ruling the IRS issued before the law change in December that said the expenses are non-deductible under IRC Internal Revenue Code Section 265, which has never been used for this purpose, but was never used for this purpose before. It was typically used for, you generate tax exempt interest income and then you pay broker fees or something like that. And so it would be like a small fraction of the income, but never for something like a dollar for dollar denial of deduction. And so they reaffirmed that. And then in that revenue ruling, the Treasury introduced a concept that is nowhere, it hasn't been found in tax law or anywhere else. And they're saying basically you have to treat those expenses as non-deductible in 2020 if you reasonably expected to receive forgiveness. And then they said it's some standards for that. So that's their solution. But for fiscal year taxpayers, this will kind of give you an idea of the problems. So, and they also said, this is their solution for fiscal year taxpayers. If forgiveness is received in the 2019 fiscal year, so let's go back to my September 30th year end example, then that would be a fiscal year 2019. And let's say they got the loan, they applied for forgiveness and received the forgiveness, then the amount of the loan that's forgiven is taxable because it doesn't conform to the Federal CARES Act. If the forgiveness is received in the 2020 fiscal year, you take the deductions in 2019 fiscal year, but then when your loan is forgiven in the 2020 year, you have to pick it up in full under the tax benefit rule. So here's the problems. This relies on their position relies on a revoked IRS revenue ruling, and that was based on an entirely different statute, the CARES Act, and that revenue ruling was expected to be challenged. So you're already basing it on something that's revoked and that had holes in it. And AB 1577 does not refer to IRC section 265 in the language of the statute as authority for why they're disallowing the deductions. And on top of that, it uses 3 different theories of taxation, depending on whether the taxpayer is a fiscal year taxpayer and when the taxpayer files for forgiveness. You have the tax benefit rule, you have section 265, and then you have nonconformity with federal law. Depending on where you fit, you're going to pick and choose. There's no consistency between the theories. So our recommendation is wait for more guidance. We were told by people, in California tax experts, that FTB is imminent with some kind of guidance. And you might want to extend your 2020 California return and consider paying the California tax for 2020, at least by the due date of the return. And so if it's finally ruled that if you don't get forgiveness till 2021, and then that's when the taxability actually occurs, and you prepaid it for 2020, then you've probably prepaid it for 3 months. So from April 15th for 2 months to July 15th or June 15th, the second quarter estimate. So you might prepay it a little bit, but it's conservative to do that. So Mark, any comments on this position? Because I think it's an important one to really look at in detail.
Sure. What I'd like to say is that, why do we even have all of this mess about California? And the reason we do is that California wanted to tax the money in 2020. If they had done absolutely nothing, there was no AB 1577, with the way California law is right now, or right then when the CARES Act was passed, it would have, the forgiveness would have been taxable without the legislature having done anything. And so all of this is about California being, in my opinion, a little greedy and just wanting it a year early. And it is, you can see the knots and how much they're having to turn into pretzels to try and get it. And it doesn't seem to be a worthwhile exercise. And the net result is that if they don't fix it, there could actually be a whole bunch of these loans that become non-taxable for California. And so, do we think that's going to happen? Probably not, because what they really want is they want the money early. So they'll probably issue the appropriate fix, but it's going to take the legislature to do that. I don't believe that the FTB has the authority to change what the legislature says as much as they think they do. And yes, they have more leeway than the IRS and Treasury do, historically, but they don't get to rewrite what they wrote. And AB 1577 is pretty clear. If once you have forgiveness, that triggers the application of the statute, which then denies the deductibility of the expenses. And if the expenses are in a different year, there's no provision for hauling that into the current year, which is what their guidance suggests it means. Well, if that's what they meant, that's what the legislature should have said. So it's just crazy.
So wait for guidance, extend your return if we don't have clarity. There might be some challenges, and maybe you want to wait to see if there's some challenges, but pay the tax for 2020 to be conservative. That's our advice. Thanks. So now let's go into PPP1. We did have changes, not just the taxability that was in the year-end act. It added new expenditures eligible for forgiveness, and this applies to both PPP1 and PPP2. And so before you still have to have 60% of your cost costs that you incurred using the loan for payroll costs. And the old law for PPP1 was that 40% had to be used for rent, utilities, and mortgage interest. And I'm probably forgetting something else. Go ahead, Mark, if I'm forgetting something.
State payroll taxes, but at most 40%.
Yeah, at most 40%. You'd have to have at least 60% payroll, and at most 40% those expenditures. Now they're adding to that, those qualified expenditures, covered operations expenditures. What is that? It would be software or cloud computing costs, all the costs that you incurred to get everybody remote, to move your office into the cloud. All those qualify. Covered property damage costs, and basically think the riots that we had, if you can think back that far, that would be added. Covered supplier costs, and this would be, if you're it's like a CPA firm, the cost that you pay to your software providers, because those are goods that are essential to the operations. So any supplier costs that are essential to keeping your business open, those count too. And then finally, covered worker protection expenditures. So all the sanitation stations and modifications to the building, partitions, things that you expended to get covered to protect your workers. So that's going to be added to the eligible expenditures, and that's for both PPP1 and PPP2.
I think the big point here is that Congress really, really wants you to pay employees. And so, if you've spent 60% of your loan on payroll, they want the loan to be forgivable. That's the point. There are all sorts of hoops if you don't pay your employees, all sorts of limits and all sorts of penalties. But if you do pay your employees, then they want to reward you for having done so. That's why we're seeing this increase in allowable or forgivable costs.
All right, moving on to the next topic with PPP1. When should I apply for forgiveness? This is our top two questions on PPP1 were taxability of the loan forgiveness, and the second one is when do I apply? So let me lay some groundwork first. The earliest that a PPP loan payment can be required is 10 months after the end of the 24-week covered period. So for most people, the covered period, 24-week covered period, and most people were using that, would be sometime, I would imagine, in October or November. So if you go 10 months after that, you're looking at August or maybe even September of, sometime in August, late summer. And that means that's the loan payment that's due. But in actuality, to to be able to qualify for forgiveness, you can submit your application 2 years after your funding date. So if you funded in June, you have until June of 2022 to apply for forgiveness and receive forgiveness. So the question is, well, what do you do with your loan payments in the meantime? Most, there's probably going to have to be agreements with banks if you want to push it out that long. And there probably is going to be loan deferments and or payment deferments and so forth. The third thing to consider is that the forgiveness process should become more streamlined as we go. And the proof is already there with the increase from 50,000 to 150,000 on the limited documentation applications. And there's also, we feel there's just going to be some more guidance on safe harbors that will make the loan application process become streamlined much more. And then also right now, more guidance, we need to get more guidance regarding the interplay between PPP-1 forgiveness and this new animal that's come onto the scene. It's not really new, but the employee retention credit for 2020. And we'll talk about that more later. And on that one point, just to give you a preview of what does that mean dollar-wise, if you can qualify for the credit for 2020, it could be worth $5,000 per employee. So if you have 50 employees in your business and you file for forgiveness right away, right now, and you could have done something different, and we don't know what that different is because we're waiting for guidance, you could be leaving $250,000 on the table. So do you want to do that? I don't think you want to do it. So what does that add up to? Wait. That's if you've been keeping up with our blogs, we've been saying wait, and as we've gone, we've been proven right time and again. And we are even recommending waiting until at least the second quarter 2021 to file. And then May or June towards the end of the second quarter to give more time for clarification and guidance that we could get. Mark, anything else on that? On PPP-1, forgiveness, when to apply?
Well, it's no, I'll defer it to later. I'm sorry.
Okay, no problem. All right, so we're going to jump right out of PPP-1 and go to PPP-2. And the big question, that number one question is, do I qualify? So the one thing I'll say, it's not on this slide, but first of all, you have to have been in business on February 15th, 2020. And that's the same for PPP-1. That's not on the slide, but that's, if you're in business on February 15th of 2020, that's the first hurdle. The second is you have to have suffered a reduction of gross receipts of 25% or more, and that's a calendar quarter 2020 versus the same calendar quarter in 2019. So this only has to be met for one quarter. So let's say the second quarter in 2020, you were down 30% in gross receipts, and we'll talk about that's the next big thing, is what is gross receipts. But you went down 30% in gross receipts. And then the third quarter, you were up 10%. The fourth quarter, you're up 10%. Do you still qualify? And the answer is yes. You only need to meet the test for one calendar quarter in 2020 compared to that same exact calendar quarter in 2019. You have the ability to utilize your total gross receipts for 2020 versus your 2019 total gross receipts. So mathematically, you're thinking, why would I want to utilize that? If I can meet it in one quarter, I'm going to, I'm going to meet it overall. Why would you want to do that? And it's really the only reason is that you can use tax returns in order to prove the gross receipts reduction rather than the other documentation that we'll go through. So that's the only reason why, it's just for simplification and providing documentation that you pass the test. The other standard you need to meet is you have to have 300 or fewer employees. So that's compared to 500 in PPP1. So you can see where Congress wanted to target this a little bit more towards small business and a little bit more towards the industries that have been hurting. And that's why they put the 25% reduction and also the lower employees. How do you know whether you have 300 or fewer employees? It's a head count. It's not, so if you have a part-time guy that comes in, works 10 hours a week, that counts as one employee. And you have to just, what's your average over the preceding 12 months? Just a pure head count test. All right. The big question on qualification is, how do you calculate gross receipts? And some people, it might matter. If you're borderline, do you calculate it using accrual basis, cash basis? Is some kind of hybrid? What's the standard? And we just had an FAQ, which will someday probably graduate into an IFR, but for now it's an FAQ that frequently asked questions from the SBA or from Treasury. Said all revenue in whatever form received or accrued recorded under the method used by the business for its books and records. And we'll more about that later, but it doesn't include idle advances or your PPP1 loan proceeds. So those are excluded. It does not include gains or losses from the sale of capital assets. I think the FAQ says capital gains and losses, but if you read it closely, it wouldn't include, let's say, like ordinary income, recapture gain from any gain, whether it's ordinary capital gain from the sale of capital assets. What's capital asset? It's pretty much anything in your business besides inventory. Your fixed assets. If you sell and you have a gain or loss, that's excluded. But are interest, dividends, and rents included? And the FAQ says yes. But looking at the statute, it points to the SBA rules, which seem to say that interest, dividends, and rents are not included. Is that Mark, any comments on that?
What's happening here, we think, is that even though it's SBA that is administering the loan program, in reality, Treasury is doing much of the heavy lifting, including much of the drafting of the rules. And so, as we'll see with the employee retention credit, the IRS version of gross receipts calculations are pretty expansive and would include all of these. And they're contained in IRC section 448 and are used for a whole variety of purposes in the code. The actual law that Congress passed in December refers or says that gross receipts are supposed to be defined as they are for the SBA 7A loan program, which we believe does not include interest and rents. It's really an operational concept. How's the business doing? What does the business need? Not what do you need, to maintain your investments. And so we think they are excluded. And why would that matter? Well, consider a business that has excess property that they rent out. The gross receipts from their business may be down by more than 25%, but because their rent isn't down at all, or is the same as the prior year, then it makes it look like they aren't, mathematically it works that they're not down as far. And so that's a penalty because you happen to have the rental activity inside the business unit. Well, that doesn't make a whole lot of sense. Yeah.
So just to kind of further go on with this discussion, we can look next at what documentation do you need to qualify. So for loans less than 150, you don't have to provide any documentation, but you have to certify. And then when you apply for forgiveness, you probably are going to have the documentation anyway. So you get it together and have it ready. But if your loan is greater than 150,000, you can provide quarterly financial statements, quarterly bank statements, or annual IRS income tax filings. And that is only if you are using the annual reference period. So go back to where I mentioned earlier about using the annual 2020 gross receipts versus 2019. This is where it would come in if you want to use income tax filings. So let's say you keep your books and records on the accrual basis of accounting, and you give those records to us to do your tax return, and we do an accrual to cash adjustment. So for tax purposes, your books are kept on cash method. For everything else, internal, you give financials to a bonding company, or you give your internal financials to your bank, then that's what you keep your books and records on. So it's really a gray area. Number one, this is not the guidance that we need. That's going to clear it all up. And the three words that I've heard talked about to describe what to do in this case is flexibility, judgment, and consistency. So that's the last point. Be consistent in your 2020 quarter over 2019. So if you use your judgment and say, yeah, I file my income tax returns on a cash basis, but if I use that, I'm going to fall short. If I use cash basis for my quarterly, but if I do use my book, report books for other purposes on accrual basis, and I'm going to make it that way, I think that's using judgment. And then as long as you're consistent. So if you're using the accrual method for 2020 second quarter, then compare that to 2019 second quarter accrual basis. So I think that's the bottom line, is just to be, there's flexibility in here in a lot of this. Uncertainty creates flexibility. And then it also requires the use of judgment. But then as you do that, you just need to be consistent. Okay. In order to get a PP2 loan, you also need, just like you did on PPP1, you had to certify under penalties of perjury that the current economic uncertainty makes the loan necessary to support ongoing operations. And I read that because that's the exact wording. This created a lot of issues and turmoil in PPP1. They created a $2 million like safe harbor, or presumption was the word, for the PPP1 loan. So if your loan was under 2 million, you're presumed to have obtained the loan in good faith, and that your intentions, that you were uncertain. And then they created a second standard for those over 2 million. So at the time, you try to remember back to where we were when you got PPP1 and how much uncertainty there was. And Congress, in its statute, CARES Act, basically gave us the rule and said, we're going to presume everybody has economic uncertainty. You qualify underneath this standard. So this time around, I think we have the same question, and we're hearing that the SBA is questioning the PPP1 loans over 2 million, and several people in our groups have said that they have clients that are getting questioned, and all the questions relate to not what was your state of mind or the state of the economy, or what your thoughts were, how uncertain it was when you got the loan, but how'd you do after you got the loan? Did you do okay? Well, if you did okay, then you probably didn't need the loan. That's kind of the attitude that's being taken. And it's using hindsight. Hindsight's 2020, right? But the whole concept of economic uncertainty is forward-looking. It's forward-looking, and it's at the time of application versus this new standard. So the question is, throw it out there right now, is there greater uncertainty now than last April? I think we had uncertainty about, it was like just getting thrown out into the cold and not knowing where to go. But do we have greater uncertainty? And in our side, we think so. And why do we think so? Well, the Fed is calling for more stimulus. We just got a $900 billion stimulus bill, and another $2 trillion that's the Biden administration is pushing to get through. So if Congress thinks we need stimulus, and we could go we need the stimulus or we could be in big trouble, why shouldn't I, as a business owner, think the same way? And I think on these loans too, for those that are concerned about the standard, and I think you need to consider it. We're not saying don't consider this for your business. You definitely need to. But Congress has, think about the safe harbor we had in PPP1. The 2 million was the safe harbor. And what's the maximum amount of the loan? Well, we'll get to that, but it's 2 million. And it's, the other was like public companies. Public companies can't get this round. You have to have 300 or less employees. So it just has a feel that just to qualify this would probably get you past this economic uncertainty standard. So I know Mark has some thoughts on this too, but maybe I covered it, but I'll let you chime in on it if I missed something.
No, I think you hit all the high points. The color commentary I'd give is that this seems to be this whole idea that we're going to have this need standard is just absolutely against what Congress intended in the CARES Act to begin with. They had to take a half a dozen different steps to say, we're not going to worry about the credit elsewhere rules that normally apply to SBA. We're not going to worry about how well capitalized you are. We're not going to worry about, what your cash position is. Congress simply decided that the uncertainty alone was enough that people might be cautious. And if being cautious would wind up with more people on unemployment and less people getting their paycheck, or fewer people getting their paycheck, that is exactly the opposite of what they wanted to have happen. So Congress did this analysis and made the decision. And so this is a clear example, we think, of Treasury saying, well, we don't really like what Congress did, so we're going to try and slow it down or not make it as big a program. So ultimately, I think this is going to go away. But we do have lots of people that are getting the loan forgiveness questionnaire when they apply, and they have large dollar amounts. And we heard from a association of CPAs that we're part of even today that some of their clients were getting multiple additional requests beyond that questionnaire. So it's clearly something that they're grappling with, but I don't think I don't think the idea is even contained in the CARES Act. And so hopefully eventually it's going to die.
Yep. Okay. So how much is the next question? PPP2, how much? So it's payroll cost. It's based on, I think we got these switched around, but it's based on 2.5 months payroll cost, or 3.5 months if you're in the hospitality line of business. So what's the hospitality line? Restaurants and hotels. Might be missing something, but that's the main category. And it's 3.5 months. It's based on your payroll cost, and it's the same payroll cost as defined in PPP1. So what's that? Wages, salaries, bonuses, retirement contributions, and not the federal payroll tax, but state payroll taxes. So everybody is pretty much familiar with that. And it's based on either 2019 costs. So you add up all of those costs for 2019, divide by 12 and multiply times 2.5 or 3.5 if you're in the hospitality line, or it's the 12 trailing months before application date. So we anticipate that most businesses are going to use 2019 costs because your payroll typically were higher in 2019, but you have that option to use 2020. The maximum amount of the loan is, as I mentioned before, is $2 million. If you're in a controlled group, another common ownership between several companies, the most you can get is 4 million combined. That compares to 10 million on PPP1 and 20 million on the controlled group. And the loan terms are the same, or not. Well, there's 1% interest is the same with a 5-year maturity. Applying. So when can I apply? And the answer is now. The 19th was the magic date. Are things going smoothly with the process? And I mentioned some statistics before, but the answer is no. There's a lot of hiccups. We've heard like the Chase Bank, they're having problems, and if you don't complete your application in one sitting, then you have to go back and restart it. But just so you know that this time around, though, it's all about options. You have options, and there's 5,700 eligible lenders, and one reason is fintech is lenders, Cabbage, what's some others, Mark? I'm drawing a blank.
Intuit, Quicken,
Yeah,
Quicken
Quicken
Loans,
Loans, all that are now all in the game. So you can apply now. Is it going back to my intro with 10 billion versus 200 billion at the same point in PPP1? There's just not the same rush. We have close to 300 billion authorized for this round. I think it's 287 or something like that. But there's not really a thought that we're going to run out right away. And it just doesn't have that feel. And then the next question is, well, if we did run out, what will the Biden administration and what will happen and what will Congress do? And like I said earlier, they have a $2 trillion stimulus plan, that they're working through. We don't know. There's business provisions of that have been given a dollar amount, but we don't know if that's PPP3 or what it is. But needless to say, it doesn't look like it's going to run out. So don't worry about that. So do I have to use the same lender as I did? And the answer is no. And we're not promoting that you leave your lender at all, especially if they were great and served you well with PPP1, and they've been in contact with you and have you have a good relationship. Use your same lender. That's what we'd recommend. But we've heard reports of many lenders that are requiring that you apply for forgiveness on PPP1 before you apply for PPP2. And that's the next question. And the answer is no, you do not need to apply for forgiveness on PPP1. So if you're getting that from your lending institution, and we just got done saying, wait for lots of good reasons. And I mentioned $250,000 worth of reasons for waiting. And the bank won't let you apply. Contact us here at LSL, and we have, available through our American Institute or AICPA, I don't know if it's American Institute, Associated International CPAs, but our institute, a lending portal program that's simplified. We can help you through that process. We'd be glad to help you out. We're not saying come with us and don't go with your bank, but we're saying if you get obstacles and you want a process that we can assist you with, and it's a user-friendly process, then we can help you. Then when you apply, you must certify. This is something, so you don't have to apply for forgiveness, but you have to certify that you have already expended or will expend by the time you get your PPP2 loan disbursement, all of your PPP1 funds, and not that you've expended all of them, but you've done it on eligible expenditures, which, remember, payroll, rent, now it includes your suppliers, critical suppliers, your PPE and all that. So you have to certify that you've done that. That's it. That's how it interfaces with PPP1. Okay. And this program, it's not just PPP2, you can get new PPP1 loans. And if you didn't apply before, you can now. That's the first rule. So you're in PP1 if you didn't apply before. And the rules are the same as last spring. So go back and review all the rules, but instead it's the same rules of PPP1, not its 500 employee limit. There's no 25% reduction of gross receipts test because it's your first bite at the apple. So it's something, if you didn't do it in round one, and for whatever reason, you can go and apply for PPP1. One thing, unlike last spring, 501c6 organizations with 300 or less employees now qualify, so you can apply. And then there's some possibilities for getting an increase. So if you got a PPP1 and you didn't get all you should have, there's a possibility. And the more we look at this, it's really, really limited, and everybody is not going to be able to get an addition to their PPP1 loan, except for possibly partnerships. So partner compensation in a partnership. So you have a partnership that has 2 partners, but they employ 50 employees and pay payroll. When you did the loan, originally there was an incredible amount of confusion and different ways different banks and lenders were handling it and not allowing you to include partner compensation. And partner compensation was limited to, I think, $20,833 per partner, based on $100,000 annual compensation limit. And going back to payroll costs, that still applies. So your total payroll costs, annual payroll costs, have to be limited to $100,000. but a lot of people excluded partners. So if you're a partnership and you didn't get the partner compensation in the first round, then you could apply in this round to get that. And it's at the most, it would be 20,833 times the number of partners. Okay, I am done with PPP 1 and PPP 2. And before we move on to employee retention credit, any wrapping comments on that, Mark? And then I'm going to turn it, and I'll just turn it over to you to kind of take it for this fun credit here. So go ahead.
Okay, I think I'm sure we'll get some more questions at the end. I've been doing my best to keep up with the Q&A box as we go. And so why are we talking about this? I'm sure most of you are saying, wait a minute, you told me I could ignore this. This is not something I need to think about or learn or even consider because I'm getting a PPP and PPP is better. Well, the reason is you could only choose one in the past, and you know, $20,000 in loan amount per employee sounded like a better deal than a $5,000 tax credit. And indeed, it actually was for almost everybody. But then this is another reason why we say there's uncertainty, and there's uncertainty that you know, the people that are in a position to know more about the economy than we are also worried about the economy because Congress decided to remove this restriction. And they said, we don't care that you had a PPP loan and got it forgiven or will get it forgiven or whatever else. We'd also like to hand you $5,000 per employee because we want you to keep employing all of your workers. And so, as I say here on the slide, Dave likes to call this the big sleeper in the act because it's really kind of stealthy because it wasn't a gigantic section. It was just, hey, this rule no longer applies. Okay, well, you have to think through, what does that really mean? And so now the employee retention credit could be worth $19,000 of tax credit per employee. You know, it doesn't take long for that to add up. I mean, so I think we can go to the next.
Okay.
Okay, so as I said, the first thing they did was say you can have the PPP and the credit in 2020. So let's talk about that. Talk about the general rules for the credit. And the first one is which employers can claim the credit. Well, there are really two totally separate tracks. One is for a quarter you suffered, and that's a calendar quarter, just like PPP2. You suffered a 50% reduction in gross receipts. Now, I do need to caution you, this gross receipts is the IRS definition of gross receipts. It pretty much includes everything coming in except for borrowings or capital contributions. That's one way, is you had a reduction in gross receipts. The totally separate way is to say that the governmental regulations related to COVID caused you to experience a full or partial shutdown of operations. And that gets that's huge, and it gets quite complicated. There is an IRS FAQ on the matter, and in big bold box on the top says this is not updated for the December law. And when they will, we don't know, but we have questions about what it takes to qualify. Clearly in California, where you had a lockdown and you were told you couldn't even have your people come into the office, that sounds like a partial shutdown or a full shutdown to me. There are examples in the rules that say restaurants were told they could only have carryout, no indoor dining, or they can only have outdoor dining and carryout. That's absolutely a partial shutdown. So then what about just a general restriction that some California counties have had on occupancy? You can open your building, but you can only have 25% as the number of people that you could have had a month ago. Is that enough? I mean, was your building ever full? I mean, there are lots of questions, but just because you didn't meet the 50% test doesn't mean you can't take a credit in 2020. So it's at least worth exploring, because 5,000 an employee is 5,000 an employee. So we've been talking about that. Obviously, the credit is 5 per employee. It's calculated as 50% of wages. So that means $10,000 of wages generate a $5,000 credit. And that credit is refundable. And I mean, it's a real credit. It's not funny money. The other thing to note here is that the aggregation rules are different for this credit than for PPP. For PPP, each franchise location stood on its own. Here, if you aggregate for IRS purposes, you're subject to aggregation. And these are basically the tests that you would apply to see if you're forced to use the accrual method on your tax return. And so why does that matter? It matters that in 2020, if you have 100 employees or fewer, or then all of your employee wages are eligible for the credit, assuming you haven't used them to qualify for loan forgiveness on the PPP. Because even though you can have both the credit and the loan, what you can't have is a credit and forgiveness on the same dollar of wages. So if you do the wages, if you have the wages and you have enough to claim both, then you can. If you have over 100 employees, then only the wages spent when employees are idle. And that's a complicated question too, because it's not, let's say you sent your employees home and they're still doing some work. Well, are they doing 2 or 3 hours of work, and are you paying them for 8? Well, it sounds to me like you've got an idle employee for part of that time. All sorts of complications, but lots of things we can help you work through and see, can we find a way to describe your operations in such a way that you qualify?
So just in 2020, what Mark said is that the $10,000 in wages that you use to get the 50%, their $5,000 credit, you can't use those same wages on your to qualify for forgiveness under PPP 1. And are we getting into that now? I'm trying to remember if we're,
Two more slides, I think.
okay, all right. I'm jumping the gun, but just remember that for two more slides.
Okay, and now in 2021, it gets a whole lot better because we still have the full or partial shutdown test, but the gross receipts test is now a 20% reduction, not 50. So obviously a great many more businesses will qualify. And this comparison is again from 2021 looking all the way back to 2019. So you're not comparing one bad year to another, you're comparing today to a pre-COVID year is the idea. Now in 2021, instead of being 5,000 per employee, you can get 7,000 for the first quarter and 7,000 for the second quarter. So that means you can get up to $14,000 per employee in 2021. And given that the governor issued orders, putting a capacity restriction on all businesses, plus all of our lockdowns that started right before the first of the year, it seems like we're probably going to be able to find some times where you qualify to take that we should be able to find some period of time that you can qualify for this credit. Now, and again, I'm probably jumping the gun for the next slide, but when we say 10,000 of wages, which wages count? Well, if you're using this 20% reduction to qualify, that's for the whole quarter, and the entire quarter qualifies. If you're using the full or partial shutdown, then only the wages paid for work or idle employees during that full or partial shutdown count. And then the next big change is in 2021, you can actually get an advance credit. You don't have to wait until you file your payroll tax return. So that literally means that even though if you say, hey, I'm going to stop making my payroll tax deposits for this quarter, but my credit is going to be more than that, can I get the extra cash now? Yeah, you can. And so how do you qualify for this quarter since quarter's not over? If you're going to try and qualify based on the 20% reduction, the quarter's not over. You can't do that math yet. So you are allowed to look at last quarter. So if October, November, December, if you were down 20% compared to 2019, you could use that to allow you to claim the credit now, even though it wasn't enough to claim the credit in 2020. So the other good news is the employee limit, the working employee limit is increased to 500. So what that means is you can have up to 500 employees and all of their wages are potentially eligible for the credit, assuming it falls into one of these time periods. Another thing, just a small tweak that was made to the credit is if you gave somebody until the December law passed, if you gave somebody a raise in 2020, or you decided to pay them an extra high rate because they were dealing with COVID, or and other hassles, those the amount of that extra pay was not eligible for the credit. But in the December Act, Congress said, "Oh, wait a minute. Whatever you pay your people, that's what you get to claim the credit on. We're not going to try and put an artificial limit on what you pay."
All right, we're going to go to the next one, right?
Okay.
What we've been waiting for.
Okay. So how to claim the credit. And we were, like I said, I jumped the gun a little bit on the gross receipts test or the partial shutdown test. To say it again, if you're qualifying under the 20 or the 50% gross receipt reduction, then the entire quarter will count. For the partial shutdown, only the wages paid during the period that you had that restriction. There might be an argument for some businesses that we've been in a partial shutdown since March. You know, you don't have to have LA County shut your entire business to be counted as a shutdown. The terminology they use is more than a nominal effect on operations. Well, that sounds like a pretty low standard to me. And the FAQ, though, is kind of wishy-washy on the subject. It's something that is very fact intensive, and we'd be happy to go through with you. So how does this coordinate with the PPP? And essentially, we threw around the whole no double dipping idea as we did earlier webinars last spring, and that still applies. Basically, you can only use wages paid, the same dollar for the sick leave credit, or the family leave credit, or the employee retention credit, or to be forgiven under PPP. You have to pick one of those. And there are some presumptions about what you're electing to do and how you're claiming them. And you should know that since they're changing the rules after people have already filed forgiveness apps, some people didn't reserve any wages because they didn't know they were going to need wages to claim the employee retention credit because they thought they weren't eligible. Well, the AICPA is already going to bat for all small business owners to say, hey, IRS, come on, back off of that one a little bit. That's a very unreasonable position to say you put it on your loan forgiveness app and therefore you can't use it. I mean, we're talking about a situation where, let's say somebody had a $100,000 loan and they put $200,000 of wages on their loan forgiveness app. Well, clearly they didn't need to put $200,000 of wages to get full forgiveness. They could have easily kept whatever they needed for the ERC, out of that, or deducted it before they went through the calculation. So hopefully that will all be resolved shortly. So that's yet another in our long list of reasons of why you should wait to apply for loan forgiveness, because it's not just the rules about loan forgiveness that keep changing. It's all of these things that keep changing. And like we said, with at least one more stimulus bill on its way, what else is going to change? Better to wait and try and coordinate these things as best we can. Now, when we actually get around to filing the claim, which will be a claim for refund, how big a hassle is that? Well, Congress thought about it and said, hey, we're making changes late in the day. Some people are going to get this all together and actually figure it out and get it done on their fourth quarter payroll tax return. That's great. Let them do it all there. What it also means is that if we're looking at your loan forgiveness app in May and we're looking at this credit in May, we can amend your fourth quarter payroll tax return then, and then simultaneously file the loan forgiveness app. And that will be only, so an amended payroll tax return may be required here, but it's only one. Okay.
All right.
Anything to add?
I think that was perfect. Just kind of going back again to the coordination and waiting, just highlighting again, you can see where what the Treasury is doing right now, why the AICPA is kind of begging them to change to make the loan application not an irrevocable election, to use the wages there, is indication that there is going to be some fighting and there's still uncertainty, and that's why we want you to wait, because if you file a return and don't put the right wages on, or an application for forgiveness, and you don't coordinate it with the ERC, then you could be losing some credit, some big dollars. And just to say, just as we can help you if you need help on applying for a loan this time, through our AICPA loan portals, biz to credit websites, we're also here to help you apply for forgiveness and coordinate that with calculating the employee retention credit. So like we are, although we're not going to be doing that now for you because obviously we want you to wait. And so we're targeting May and June for that. So keep that in mind. We're here to help you. We have some tools with our association's site that will hopefully, and through guidance from us, that maybe instead of getting, taking dozens of hours of your time to get all the information together, maybe we can help you streamline that and minimize the time and headaches involved. So again, we're here to help you on that too. So just contact your partner, or us here at LSL, and we can help you with that process too.
Dave, we've
So,
got a bunch of questions that have come in on the ERC. Would be appropriate to take those now before you go to, or you want to defer them?
yeah, let's just defer them,
Okay.
because I'm not going to really build a lot. I'm just going to go really quickly over a summary of some of the major tax provisions. And we realize that the heart of this is, PPP2 qualification and the employee retention credit. So we'll just do it all at the end probably. Let me just go over these provisions. So the stimulus bill, what's the acronym? We have like 3 or 4 different acronyms for it, but we can't figure it out. We just call it the year-end bill or stimulus bill.
The granddaddy 5,700 page bill is called the Consolidated Appropriations Act of 2020. But each of the major divisions are, essentially have their own name and their own act. And there's one that's abbreviated TCD-TRA. There's one that's called the COVID Aid Act, or no, what was the?
Yeah, I think.
Yeah,
Yeah. So
that's why you see it calling
CAA,
it this.
is it CAA? Is that a good way?
Yeah,
Okay.
that's
The
you
whole thing.
can't go wrong by calling it CAA, because that's the entire thing.
So there was extenders in the bill, and what was made permanent was the medical expense deduction floor. When you're itemizing deductions, it's now going to be permanently 7.5. And there was a few years back, and then the CARES Act brought it back down, I think, to 7.5, but it was up to 10%. Now it's permanent 7.5. The Section 179D deduction for energy efficient buildings, that's been made permanent. 5-year extensions through 2025. Work opportunity credit. I know we have clients that claim that. For those that financially have been devastated by COVID, and they have discharge of indebtedness on their principal residence, that exclusion, but it's limited to 750,000, is extended for 5 years. Exclusion for employer payments of student loans. 2-year extensions. This is, the solar credit that a lot of you got, putting panels on your house, the Section 25D credit. It was scheduled to go from 26% in 2020 down to 22% in 2021, and I think it was going to phase out in 2022, but now it's been extended for 2 years. So for 2021 and 2022, it will be 26%, and for 2023, it will be 22%.
Mhm.
Section 48, energy investment. So this is the business side of this Section 25D, which is the individual residential. That got a 2-year extension, the 30% credit. And the 1-year extension for the qualified business energy property. So that's like energy efficient windows, things like that. Just to be reminded, I think that's you can only take that credit one time, lifetime, for $500, but that's been extended for another year. Qualified mortgage interest premiums are still qualified residence interest for another year. And then there was some sections 30, 35, 40, 45 credits. I'm not going to go into those that were extended. So CARES Act extensions, educator expenses still for another year will include PPE. Payroll tax credits for paid sick and family leave. Now that it extended it, it didn't increase the credit. So I'm trying to remember the amount of the credit. Mark, do you remember that?
Basically, it's up to $500, $511, I think, per day per employee for 80 hours of paid sick leave. So
Right.
So that 80, when Dave says it wasn't extended, it's the same rules that existed last quarter. It's that between March 12th, I think, or something like that, when it started, there's a total of 80 hours of COVID related sick time an employee can claim. And, the option, or, the interesting thing here is that it is optional for employers to offer the paid sick leave and family leave for the first quarter. But if you offer it, you get the credit.
And you can't go beyond, it's not increasing the 80 hours.
No, but my best guess is that whatever bill we see in February is likely to say okay, you get 80 hours for that one 12 calendar month period, and we probably will get something additional starting in March.
Okay.
That's my guess, because
Yeah, most
there are
likely.
people.
Yeah. And then what was extended was the deferral of the employee's portion of the payroll tax. Now, this was the portion that was enacted by President Trump at the time, signed an order, and it was optional. And I don't know of anybody that actually went into it, because there was a lot of pitfalls and potential problems with it. The big one that a lot of you utilized were to the employer's portion of the FICA, the payroll tax. You could defer and not pay until half of it at the end of 2021 and the other half at the end of 2022.
Mm-hmm.
So you had an interest-free deferral on the payments. That provision did not extend. So as of 1/1/21, there's no more deferral of employer taxes. Other tax provision, kind of a nice one to try to get the hospitality industry going, is that typically for businesses, you have to limit your deduction for business meals to 50%. And for expenditures incurred between 1/1/21 and the end of 2022, it's 100% deduction, but it has to be provided by a restaurant, I guess, as opposed to, I'm not sure, a catering company or something. I don't know, but as long as it's a restaurant provided meal. And then you had in 2020, you're going to have a $300 above the line for a charitable contribution that you can take for people that don't itemize. And the way the law was written, for joint returns, it was $300, and for single married file or just single would be $300. And they fixed that law to make it $300 for single and $600 for joint return. And they've also anticipate that, since this is, going to open it up to non-itemizers, just writing down, automatically putting $600 down for it. If they audit and find that it wasn't a correct, you didn't make those charitable contributions, then it's a 30% understatement penalty on that. Education expenses, there's a change for 2021 forward. No more tuition, qualified tuition deduction. Instead, they've increased the phase out limits on the lifetime learning credit. And then modifications of limitations on charitable contributions. Right now in 2020, by the CARES Act, we've had a 100% AGI limitation on most contributions, like not to foundations and other things, but you can have 100% of AGI, adjusted gross income, and also extends the corporate limit of 25% of income as the deduction limit for charitable contribution. And then they also put if a corporation donates to a qualified disaster relief fund of some sort, effort, then they can get 100% limit. So it's limited to taxable income. Non-COVID-19 disaster relief, and I stress non-COVID because there is, COVID-19 is considered underneath the presidential declaration, and there's an act, and it's not coming to my mind right now, but that it is a federally declared disaster, but these provisions were just put in here just and specifically said it's non-COVID-19. And it just mirrors kind of the use of retirement funds for the COVID-19 rules, but you can take out 100,000 of qualified distributions penalty-free if you're in a disaster zone. You know, we've had a lot of fires and other things that would maybe qualify, and then the income over 3 years or recontributed to the plan. And this is for both qualified plans and IRAs. And then personal casualty losses for qualified disaster. And again, this is COVID-19 is explicitly excluded. And the interesting thing is it eliminates the $100 floor and 10% of AGI and replaces it just with the $500 floor. But it also adds, if you don't itemize, that's where you usually claim the personal casualty loss on your itemized deduction. You can increase your standard deduction by the amount of the loss. And I presume it's reduced by the $500 floor. Okay, that was it. And Q of A, and why don't we hit the ERC, since you had some questions on that, Mark?
Okay, before we do that, Brian Totto in our Santa Ana office wants us to not forget that the federal empowerment zone was also extended 5 years, and that is of great interest to many Santa Ana clients.
Okay, so thank you, Brian. I picked and choose, and
yeah.
And I probably didn't catch everything, but that's great.
If you read our December blog, we said that Blitzen couldn't make up his mind, that there were so many goodies to choose from. And Dave and I, we agree with Blitzen. We still agree with Blitzen. So the few that we had on ERC is it a state or a federal credit? It is only a federal credit. So what that means is if you use 10,000 of wages for an employee to get the credit, whether it's 5,000 in 2020 or 7,000 in 2021, that $10,000 will not be a deduction on your federal return. But yes, it will still be a deduction on your California return. So you don't get a California credit, but you do get a California deduction just like you would have anyway, or normally. And okay. And in one question is asking about the occupancy restrictions and where do we find these governmental orders? Well, you know, they could come from the governor's office, and there are lists on the governor's website, but it's not limited to just the governor's office. I mean, and his emergency orders. It could be from the county Department of Health that says no indoor dining. It could be from, you know, I mean, it's, well, the technical wording of the statute for the credit talks about federal agencies. They have already, they've said from day one that, well, you're either relying on direct rules from the federal agencies or indirectly through the state governments that are, you know, both state and local, that are interpreting those rules, and so those all qualify for the credit. Basically, if a government agency told you you need to do this differently, then that potentially would make it so that you could qualify for the ERC. Okay.
So Mark, I think too that it's like what documentation, so when you claim the credit and you take the position, what documentation will you have to provide? And I think you just take it on your amended payroll tax return or your payroll tax return, but then you need to have documents, showing the order, the time frame of the order, and probably how it affect, some kind of narrative on how it affected your business. Um, it's we don't know where everything's going to end up on this. Mark, we talked about these FAQs that are out, and right on top of the FAQs are a statement that says caution. These FAQs were drafted before the CAA, I'll call it the CAA, in December 27th of 2020, and are subject to change. So are they going to say, oh, now that this could be a big, help to a lot of businesses, we're going to change the standards and define the standards differently. So we don't know yet, but think documentation. It's like, what would you need to win in a dispute with them? What kind of documents can you provide if you were making your case?
So we have a question on the aggregation rules and saying, I converted my business from an independent to a franchise on December 31st. How does that affect my business? Well, if your business is in one location and you're less than 500 employees, it really doesn't. If you had multiple locations or more than, and together they added up to 500, well, being a franchise is to your benefit. We're sent. Okay, I'm not sure what Kevin's asking.
So they sent people home, and because of a government order, so you had a shutdown, and they were probably idle. It sounds like if they were idle, then their wages would qualify for the ERC. Now it's just coordinating that with your PPP.
And if you're asking, if you filed an application, the IRS's position is you've elected not to claim the credit, which is what we were talking about earlier, that the AICPA is going to bat for everybody to say, hey, wait a minute, how can you penalize people for something they didn't know about? And if full forgiveness could have been granted on a PPP loan forgiveness app with lower wages, then only that lower amount of wages should be counted as not being eligible for the credit. So hopefully that will be the case. I mean, since the PPP loans were based on essentially 2.5 months of payroll. So let's call that 11 weeks. And you actually get 24 weeks to come up with payroll for loan forgiveness. It's fairly likely that there's some money left over that you could use for a credit as well. So I think that most people that qualify for the credit will be able to find wages to use for the credit. I
agree.
So Dave Hale is asking if we paid 10,000 and used 10,000 for PPP, does the other 10,000 qualify for the ERC? That's exactly what we're talking about. If you filed the application, the IRS is looking to sting you, and hopefully they're going to change their mind on that.
Yeah, and the answer is you can use it, but you have to qualify for the ERC first. So, you know, you have to meet the 50% reduction in which would get everything in. You're in the door, you're golden if you get the 50% reduction in gross receipts, or you have a full or partial shutdown that impacted your operations more than nominally.
And so Mike is asking a similar question that is, I use a payroll company, should I have them stop paying taxes? Well, only if you already qualify for the ERC. I mean, if you know you qualified for the ERC in 2021, because, and the only way you can know that is that you qualified based on 20% reduction in gross receipts last quarter, because that's the only way you know you qualify for the entire quarter of January through March. If that's the case, then yes, you could. Are the payroll companies up to speed yet? I think not. I think if you tried to say to somebody, stop making my payroll tax deposits, you might be a week or two ahead of them before they get that figured out. So worth a try, but the real key is, do you qualify? And you don't want to pay payroll tax penalties, so be certain you qualify before we do that. And let's see.
I'm not sure of the next one.
I'm not sure what's okay. The question is coordinating multiple credits. Can you get the 5110, which is the $511 a day times 10 days or 80 hours of sick pay, and then after that 2 weeks has been used, can you move to the family medical leave, which is up to $211 a day for some number of weeks for taking care of a child that you don't have daycare for? Yes, that's true. I'm a little confused by 2,000 for taking care of somebody else. I'm not sure what the third part of this is. I apologize. I don't know what credit you're referring to. And then Michael is asking about that Cal OSHA says that you have to offer 30 days sick leave. Honestly, I'm not familiar with that rule, and I'm also not aware of a federal or California credit other than the 80 hours. So I'm only aware of the 80 hours, and I don't know if that's paid sick leave. I don't know what this rule is that you're referring to. I'm sorry. And what's my best guess about what's going to be in the 2020 or in the February bill? Unfortunately, lots of things. We know that the Democratic House has been trying to get essentially block grants to states ever since this started. And so that's likely coming. We know that there are lots of I'm sorry. reading the next question. There,
It's
there,
okay.
there are lots of opportunities to increase taxes. I don't know if they will be that silly. I mean, increasing taxes at the same time you're trying to produce stimulus. You know, those don't go together. Just intuitively, you know that they're not right, but they are very eager to raise taxes on people with incomes over 400,000. And you know, but I think maybe the question was getting at, what do I really expect to have happen with the emergency paid sick leave and the expanded family medical leave? Well, as far as I know, most school districts are still not back in live on-campus learning environments. So would it be appropriate to continue to offer some sort of family leave, to care for children that aren't in school? Yeah. Is it possible that somebody got sick with the COVID-related, issue, or was quarantined or something earlier in the year, and they've used up those hours, and now somebody in their household gets a new quarantine order, or actually gets sick, or whatever? Yeah. So, I mean, would it be reasonable to say this 80 hours is an annual limit, and we're going to roll it from March to March or April to April? Sure. There are lots of things that they could do. It and I don't know that anybody's got a really great crystal ball about what Congress is going to do in the first 100 days here with President Biden. Hopefully they'll continue to do things that make sense and support employees and employers, but we'll have to wait and see.
Yeah, just a couple things to add on that. We do know for certain what the economic impact payments are going to go up. What were they, $600 basically per person to $2,000. So that $1,400 per person is, I think, takes up 300 or 400 billion of the amount. Also extending and increasing the unemployment compensation, and that takes up a big amount. There's amounts just for business relief, but there's no specifics on that. But the flavor of it is going to be more relief for, direct payments to individuals, disadvantaged, unemployed, and bailouts of state and local governments. So in California, I don't know, we will be one of them. Obviously, blue states are going to get rewarded, but we've sat in on the Chapman economic forecast, and California is not in dire straits like some other states. So, but we'll probably still get a fair share of that $2 trillion.
That's what makes the whole push to try and tax the PPP money in 2020 so ridiculous. By the time the state's looking at their January and April collections, there'll be very little in the way of budget deficit for last year. Well, I guess technically it'll carry over year to year, but yeah.
Yep.
What Chapman had pointed out to everybody is that this recession, at least for much of California, was very much a V-shaped recession. That that we went down hard and fast, but came back, in a quarter later pretty well. So
I think that's it. I think Michael was just clarifying some of the Cal OSHA stuff, and we can address that off. We're just not aware of it, but go ahead and send Mark or me or somebody here at LSL what you found on it, and we can address that with you. And if you have other questions that you just didn't get around to asking, and you know, after you absorb this, then just contact your representative, your partner, your who you're used to dealing with at LSL, and we'll be glad to assist you and help you out. Anything else that came in on chat or?
I think you've covered it all. So great job.
Okay.
I want to thank all of you so much for attending today. We appreciate you being with us for another round of Dave and Mark discuss all things PPP and guidance. And wanted to remind you that this recording will be sent out to you along with the slides tomorrow morning. So look for that in your inbox. And it looks like we do have one last question, Dave, from Polly.
Okay. So it was disqualified for PPP1. So if it received, so I guess maybe the question is that you received $10,000 a loan and you didn't qualify for forgiveness, maybe, then it's not going to be forgiven, and therefore it's just like any other loan, not included in income. I think that's.
she might be talking about the $10,000 EIDL grant, because she said they weren't qualified for a PPP.
Oh, okay.
So maybe that's the EIDL grant.
The EIDL loan. Okay.
And most, so the EIDL grant is not taxable for federal purposes. And I don't know about California because it is a grant. It is not, I don't know.
It's not. It's still a loan though, because I think the L in EIDL stands for loan. So I think it might be taxable for California, but we don't know right off the top of our head.
What we do know about EIDLs is that it used to be that you had to reduce, if you were lucky enough to get an EIDL, which, you were supposed to be able to get an EIDL for a lot of money, but and only the first 10,000 could be converted to a grant. But if you have an EIDL, you do not need to reduce your forgiveness by the EIDL grant. So that's the good news. That meant people that did manage to get one, it really was something extra, not just another way of getting a PPP loan. And so there were provisions in the December Act, or pardon me, there was money appropriated for additional EIDL grants, because a lot of people looked at it and said, I'm not really getting anything because it's going to reduce my PPP forgiveness. So it's not a grant. I'm just going to pay it back on this loan instead of that loan. And so now more people can go and get EIDL loans, but they require actual economic injury as opposed to just uncertainty.
All right. I think that does it. Thank you, everybody. We really appreciate that you took the time to listen in, and hopefully this has been helpful. Like Jill said, we'll have the slides and links for you tomorrow. And again, if we can help at all, either in applying for PPP2 or getting applying for forgiveness and coordinating the employee retention credit and helping you calculate that, we are here to help you. Thank you.
Thank you.
Thanks, everyone. Have a great evening, and we'll see you next time. Bye.
Bye.